BI, SEBI, and trading begin with dollars, USD, and Indian currencies. Future currencies allows your investor to buy or sell their currencies at future date at a price which is fixed already. And this trading, buying and selling, is considered to be trading. Okay, the word we use is trading, and trading of these instruments on BSE and NSE, like stock exchanges we call, facilitated and encouraged revenue, additional, ways for, with respect to the investors, corporates in India to hedge their foreign currency exposure. And because of these foreign exchanges, there was a lot of transparency in dealing. Stock market happened to, have been transparent enough to show the prices, quotations, daily basis, opening, closing, etc., which facilitates transparency and encourages more and more. It attracts more and more, investments towards it. Now, stock exchanges has a big size. That there are a lot many currencies which have been identified, like USD or GBP and Japan yen. In order to settle down the these tradings, it has to be converted back into Indian rupee, INR, and there are conditions and time period during which they can allow and facilitate this to the investors. Let's see in detail the meaning of currency futures. And now this currency future is also most popularly referred as FX futures. This is an exchange of one currency on a specified date. Here, date plays an important role. Okay, on a particular date for a particular price. That price we call it as a future price or exchange rate, which is already fixed. And this we are going to exchange on a future particular date. Okay, now on NSE, if you look at a price for a future contract is in terms of Indian rupee per unit of the currency. Example like US dollars, currency derivatives are available on 4 currency pairs. We have recognized currency pairs in the recognized currency pairs on the NSEs are US dollars, Euro, which is abbreviated as EUR, and then we have Great Britain pound, GBP, and Japanese yen. Cross currency futures, option contracts, Euro USD, BP USD, and are also available in trading in currency derivative segment. Now, moving on, in case, suppose an exporter from India who's expecting some payments in US dollars for the trading that had happened. Now, this can be hedged either going long or short in the future market. Now, this allows the hedging of volatility in the currency market. Now, features of currency future contract. Now, what are the various, features of the currency futures? These are summed up under few main headings, which are contract size. Now, size plays an important role under currency futures. Like, see, each participant can trade, the currencies for some quantities. Now, the exception of Japanese yen, the standard contract size is fixed at 1,000 units only. And if you look at British pound at CME, it's 62,500, whereas for Japanese yen, the contract size is only 1 lakh. So the future currency contract specification in India is presented here in table 5.1. You can see here in the table, Monday to Friday, 9 to 5 p.m. Expiries is 2 days. These are all the, conditions based on which the future currency functions, right? Price quotations, we have INR per unit of any foreign currency within 4 decimal places, yen 100 up to 4 decimal places. Tick size, settlement mode is cash settlement, daily settlement price is 30 minutes. Weighted average method is used for 30 minutes. Then we have base price as the first day of the contract and daily settlement per remaining. Margin price is given. Daily price variation is given, which is plus or minus 3% per contract up to 6 months. And if it is greater than 6 months, plus or minus 5%. Okay. Next, moving on to contract expiry. When does it get expiry? Okay, now the future contracts are standardized for the delivery dates. Dates are very clearly mentioned. If it matures on a specific date, which is already known to the participant, that's the investor, all future contracts have to be settled at the end of the respective month. Any month, at the end of each month, it needs to be settled. Now, since spot markets provide 2 business days for settlement, this we have learned in the earlier classes of IFM. Spot market, it takes 2 days for the settlement. Okay, though it is considered spot exchange rate, but yet it takes 2 settlement days. So the expiry here for future contracts are fixed 2 days prior to the last date of the spot transaction for the month. Suppose if it is 31st of March, okay, so 2 days prior to 31st March is considered as in contract expiry date in case of future currency futures. Okay, then we have use of PITs. Now, brokers are, happen to be an intermediary, and these brokers facilitate trading. They happen to do a lot of exercise on behalf of the participant, and these are known as the trading roofs. We call them as pits. Usually, sometimes these are also called as scalpers who held their positions long or short for a few minutes. Brokers trade on behalf of their customers. Now, for the services that they are rendering, they charge commission broker or floor brokers. Now, traders acting for themselves as well as on behalf of their customers are known as dual traders. Now, there may be cases where a person is not only just doing for themselves investments and trading, besides he is also trying to help others. So, in such cases, he is called as a dual trader. Then we have the next feature in the form of clearing house. What is clearing house? It's a place where, it's a small place of the whole system where a trader strikes a deal. Okay. The buyer and seller agrees upon a particular price, quantity, maturity. When all these are aligned, then we call it as a place where, the transaction is taking place, and that is referred as clearing house. This offsetting or netting process takes risk out of the financial system as a whole. Then we have margin money. Now, what is margin money? It is a money that has, that denotes the deposits of the clearing house with the adjustments of gains or loss. Now, the above you've seen what is clearing house. It's a place where the settlement happens for a particular price, quantity, and on a maturity date, right? So whatever on that day transaction is been presented, and at the end of that settlement, whatever gains or losses have been deposited, and this represent traders deposit with the clearing house. This is referred as margin money. Maintenance margin is the minimum level to which the margin is allowed to fall in the sequel of loss. The variation which happens, depends on the probability of exhaustion. And usually the probability of exhaustion is calculated with P is equals to 2 of 1 minus N of W, where W is D of V into K into under root T, where D is cash deposit. Okay, D is cash deposit. V is standard deviation of the daily change in the price. And K is the value of one future contract. T is the number of trading days over which calculation is based. Cumulative distribution function for standard normal variance. Okay, then we have marking of the market. The marking of the market involves comparison of spot market, what was yesterday's rate, and what is up to the maturity, and based on these you happen to calculate either you have incur gain or loss. The position of these contracts of each participant is market to market. On a daily basis, settlement is done at the end of each trade day. The clearing members, so-called clearing members, who have suffered any losses, to pay the market to market loss amount to clearing house. Now this on a daily basis, after daily settlement, all the open positions are reset to the daily settlement price. And these members are responsible for collecting and settling the daily mark-to-market profits. Okay. Then we have methods of transaction. What are the methods of transaction? Currency future contracts, instruct the agents who also acts as a commission broker at the stock exchanges, that's NSE and BSE. After the deal is executed, the commission broker confirms the trade with the agent of the trader. Now with this, the principal deposits of the margin money with the clearing house at the very start of the next day. Next we have order matching rules. Now, what is order matching rule? The best buy order, which is one of the highest price, and the best sell order is one of the lowest price. And here any order can match partially, or multiple trades can be the results thereof. The best buy order will match the best sell order. Therefore, it is the order with the highest price or lowest price. Hence, here in any given market, at any point of time, a seller would obviously like to sell at the highest possible buy price, which is offered. Okay, then moving on to the next one, which is type of order or order conditions. Now, there are two categories basically, time related and price related. Okay, now what is time related? Time related is day order, immediate or cancel order. Now, this is all based on the time, tenure, duration. Okay, and it is an order in which a valid for the day on which it is generated. If the order is not matched, the order will get automatically cancelled. Likewise, immediate or cancel order. Partial match is possible for the order, and unmatched portion of the order is cancelled immediately. Next, we have price related conditions. Under this, you have limit price and market price. Stop loss price, or we call order price. Now, what is limit price? It is specified while entering the order into the system. When a investor or the participant gets into this, a price is quoted. That price is in which is mentioned at the system, that is a place where the transaction is happening. That is referred as limit price. Market price is the price where you buy or sell at the time of entering the order. And stop loss price or order price is nothing but it allows the trading member to place an order which gets activated only and only when price of the relevant security reaches or crosses a threshold price. Until then, the order does not enter the market. Next, we have cost in future deals. Cost in future deals here three types: brokerage commission, floor trading, clearing fees, or delivery cost. Now, brokerage commission is a a charge for the services what the agent or broker is rendering on covering completely his services on opening and reversing the trade. Then we have floor trading and clearing fee. Floor trading and clearing fees is all about the charges which are associated with the clearing house. This is basically in the form of fee which is included in the brokerage commission at the local trade, and this fees does not exist. Okay, then we have delivery cost. What is delivery cost? It is a cost. It is related to the currencies. Okay, since the actual delivery of the currency will not happen here, such cost is not common. So delivery cost is all related to the delivery of the currency. Then we have limits. In order to prevent sudden and violent changes in the price of underlying currency, there is a limit on anything which is prescribed, and this is determined on the floor of the exchange by both the forces of demand and supply. And when the price moves above the specified limit amount, the future contract is known as limit up, and with no further trading on the contract for the day. Then we have organized exchanges. What is organized exchange? There are some future exchanges which trade in commodity futures as well as financial futures. Now, in any organization or institution, a facility to trade future contracts is organized. It's through organized exchanges. Now, there are at times financial futures being traded, in a separate futures and option exchanges. Next feature is long position and short position. What is long position and short position? Now, suppose there are two parties to every future contract, such as a buyer and seller. Act of buyer future contract is characterized as going long on the contract, buyer. Whereas the act of selling a future contract is similarly characterized as short on the contract. Okay. Yeah. Next, we have open interest. What is open interest? It is the total number of outstanding derivative contracts, such as futures or options. For example, trading activity in future markets for traders, suppose A, B, C, D, E are presented here. Now, this is a trading table showing the transaction time, trading activity is given, and open interest is given. On 1st August, A buys one future with B, sells one future contract. Okay, open interest is 1. And then we have August 2, C buys 5 futures and D sells 5 future contracts with the interest is 6. So here an interpretation we can see, suppose in August 2nd transaction, 5 new contracts are created. So open interest is increasing to 6. On the same line, if you look at 4th August transaction, E buys 5 futures from C, who sells 5 future contracts. See here, in 4, open interest remains at 5. There are no new contracts created. Investor E bought 5 existing contracts from C, which is already possessed by C. Okay, now we have an illustration here on the size of variation margin call. The data is given. This is the formula. And let us now look at this illustration too, wherein for better understanding of currency futures, let us look at this example and try to analyze and interpret, understand the futures. Okay, so let's see. Here, an Indian importer buys 1 lakh US dollars in future markets, and the price as on that date is 68 rupees 75 paise. See here, after decimal 4, the conditions you've already learned. Okay, 7500 is presented in dollars for the purpose of hedge on 10th August. The maturity falls on 17th August. The spot exchange rate of INR per USD is as follows. On 11th, the rate is given. On 12th, 13th, 14th, 15th, 16th, 17th, respectively, the rates are given. Find out how much will be added or subtracted from the margin money. Now, for this, we know the formula is either it is a gain or a loss. This you will know by subtracting closing minus opening rate. Now, on 11th to 17th, we have to calculate. So, write down all the dates from 11th to 17th. Now, see here, on 11th, the closing rate, that is 68.7520. Okay, then we have 68.7500. Where is this? Here it is, dollars. On 10th, this is the closing. That means it becomes the opening of 11. Now, this being the opening, here you can see 68. What is the closing on 11? 68.7520. This will become opening of 12. Okay, then we have 68.530. Here it is 68.530 of 14th August, which is closing. Opening will be the previous day's closing. Always remember, opening rate will be the previous day's closing. So here you can see 68 on 11th, if it is a closing, it is opening of 12. The same line, 68.7550. Here it is. So on and so forth, you can see. Now, the difference of 68 opening and closing minus opening is considered as gain or loss. If it is in negative, we consider it to be loss. If it is positive, we consider it to be profit. All right. So, here we go. Net gain, if you add up all, we have 0.0080. Now, this total gain is multiplied with the 1 lakh US dollar, which an Indian importer buys. Here, the INR 800 will be added to the margin money. Is this clear? I hope you will be able to solve the remaining problems. Okay, next let us move on to the next topic, comparison between forward and future contract. Here the forward and future contract is being differentiated on these lines. Around 16 headings we have. Let's start with meaning. Now, forward contract is an agreement between parties who buy and sell, whereas future contract is a contract in which parties agree to exchange assets. Okay, here buying and selling is not focused on. Under future, it is exchange of the asset as a fixed price at a future specified date. Now, if you look at the nature, it is customized, whereas future is standard. There is no change. Now, trading can happen on OTC, that's over the counter, but for future contracts, it only happens on the NSE and BSE. Now, look at the settlement. Settlement for forward contract happens only on the maturity date, whereas for future contracts, it is on daily basis. The risk is very high. And here, because it is standardized, the risk is quite low. Default, as there are private agreements, the chance of default are relatively high. But here on futures, if you look at, these are traded on NSE and BSE. So there is no scope for such default, risk. Now, size, if you look at, it depends on the term, long term, short term. Here for futures, it is fixed. Collateral, if you look at, there is no need for collateral in forward contract, whereas collateral initial margin is required if you happen to do it with futures. Maturity, if you look at, as per the terms of the contract, it is, whereas futures, they are all predetermined and they're all regulated. Under regulation, forward contracts are self-regulated, whereas the future contracts are regulated by stock exchanges, that is NSE and BSE. Liquidity, it is quite low in case of forward, whereas in future, it is very high. Volume of transaction, that's very large, whereas in the standardized future, it is very low. 1% it is just of the forex markets. Commission, if you look at, yet the commission is called as spread. We learned in the previous IFM classes between the banks buying and selling. There's a brokerage fee here. The bid offer spread is tighter here, whereas in the forex market it is greater. Price information in public domain, yes, it is not available and it is not visible. Whereas if you look at this future contracts on daily basis, some news channels, if you look at, they keep on showing the analysis and interpretations on the market, prices. And these are all available at public domain for the facility transparency of the public investors and participants. Anywhere, from anywhere across, you can, watch how your investments are doing. Price discovery, here it is not possible in case of forward, but in case of future, yes, it is possible. So these are the major differences between forward contract and future contract. Then we have hedging in currency future markets. Now, what is, hedging in currency futures market? Future contract is used to hedge against foreign exchange risk by fixing the price at which a currency can be obtained. This contract is then priced every day. Suppose if some losses are incurred on a regular basis, then the company is required to add more funds to margin account. Suppose the various terms which are used usually in hedging a ratio are: hedging refers to making an investment to reduce the risk of adverse price movements on account of currency. Currencies are exposed here. Hence, this is used so that the risk is reduced. Suppose in a perfect hedging, a trader undertakes a position that would eliminate the risk of an existing position. It's a mathematical formula which is used to value the position in an underlying asset. Okay, hedging cannot be perfect in the following situation. There are certain limitations where hedging cannot be applied. What are those? Non-availability. Sometimes features are not available on the currency. In that case, this will not be, hedging will not be possible because the currency gets mismatched. Delay in cash flow. Usually, the cash flows occurs before the expected date, and this becomes necessary to liquidate the hedging contract before its maturity date. Maturity mismatch. Usually, in reality, it happens the date of future contract may not correspond with the cash flows to be hedged. And this particularly leads to mismatching of the maturity. Look at the size. Future contracts are available in fixed and standard sizes we just learned in comparison, right? Therefore, the size of the future contracts may not match with the size of the cash flows. Okay. Now we have some underlying mismatches because of which the maturity of the underlying cash flows and the future contracts leads to some other. And these other types of hedging we call it as delta hedge, cross hedge, delta cross hedge. What is delta hedge? It exists when the maturity does not coincide with the hedger's need for the currency. Cross hedge exists when the amount of future contracts does not tally with the actual amount to be hedged. Delta cross hedge is a combination of both delta and cross hedging. Here we have some illustrations to work on to identify and to interpret the results, strategies which can be followed. Here we can look at this illustration number 4, which is given the standard deviation spot prices of live cattle, and it is 1.2. The standard deviation of monthly changes in the live cattle is 1.4. And here the correlation between future price and the spot price changes is 0.7. Now on October 15, a beef producer is committed to purchase 2 lakh pounds of live cattle on November 15. The producer wants to use the December live cattle future contracts to hedge its risk. Each contract is for the delivery of 40,000 pounds of cattle. What strategy should the beef producer follow? Now see here, the optimal hedge ratio is the correlation into standard deviation and divided by the future standard deviation. Okay, spot standard deviation is 1.2, future standard deviation is 1.4, and the correlation is 0.7, which is simplified at 0.6. Now, if you look at this long position, we are said that 2 lakh pounds of live cattle, right? 2 lakh into 0.60 is 1,20,000 lbs of cattle. As a beef producer should therefore take a long position, that is 1,20,000 divided by this 40,000, closing out the position on November 15. So this is how you're going to use this optimal hedge ratio formula. Find out the ratio. With the help of ratio, you can find out the long position as on that date given and conclude your working. All right. Then we have another illustration, also is based on the table, which is where you have to calculate the hedge ratio for the settlement. Okay. Then we move on to learn about speculations, anticipations with the currency features. Now, there are two major. The former is called intra and the later is known as intercurrency spreads. Now, what is spread currency trading? It's a straddle. Okay. Spread trading is also called as straddle. If the speculator and in anticipation of actual spread in the future, that's profit in the future, would be different from the quoted profits or spreads, they may use the spread trading to gain from such differences. Under intercurrency spread, that is currency features in two different currencies with the same maturity are quoted at two different rates in US dollar. This will reverse both the contracts before maturity, and the loss in one would be covered by the profit in the other day. So out of these two currency, you would buy currency futures in the currency, which is expected to appreciate relative to other currencies in the future. Okay. Then we have few simple problems here. You can see if pound future contract is available at this price and the euro future contract is available at INR 61.250, pound is expected to appreciate and euro is expected to depreciate. In such a situation, if a speculator will buy pound future contract and sell them at euro future for the same maturity, if contrary to the expectations, pound depreciates and euro depreciates, find out the gain to the speculator from intercurrency spread. Now look at how we can calculate loss on pound future contracts. It's given as 61.690 INR minus 61.680 pound depreciation. So the difference is INR 0.010 per pound. Our total loss is 1,000, right? So here, if it is 0.010 into 1,000 INR 10. On the same lines, euro future contract, which is gain 61.20 minus 61.235. In this case, 0.015 per pound. Okay, suppose if it is 1,000, then it is INR 15. Here you can see clearly, in case the speculator wanted to convert, sell the pounds in expectations of euro, then the net gain which you would derive is INR 15.15 minus 10, which is INR 5 as gain. Right? So this is how very simple and easy to go with the problems are available. All of you can give a try and focus on learning the conceptual knowledge, developing conceptual knowledge on what is future currency, hedging ratio, cross hedging, then delta hedging, followed by in detail try to learn all the features of future contracts, differentiate forward and future contracts, inter and intra currency spreads, situations, open interest, all this you can give a try, followed by try to give focus on doing these simple problems which are there at the exercise level. Now with this, unit 5 is done. Yes, unit 5 is done. Yeah, we'll see you again in next class with unit 6. Thank you. And we'll end up the session here.